This is the Monetary Policy Review number 5 of 2025. And the Monetary Policy Board met yesterday for the 5th time in this year to decide on the monetary policy stance. And Monetary Policy Board decided to keep the overnight policy rate unchanged at 7.75%. And also the margins for determination of interest rates for standing facilities of the central bank remain unchanged. And also statutory reserve ratio remains unchanged at 2%. Let me briefly go through the main factors that were considered by the Monetary Policy Board during this review. The Monetary Policy Board was of the view that the current monetary policy stance, that's the accommodative monetary policy stance, will support steering inflation towards the target of 5%. So if you see the real sector of the economy is estimated to have grown by 4.8% in the first half of 2025 as per DCS data. And we got Q2 data, so that's there was an expansion of 4.9%, the economic expansion. That was the 8th consecutive expansion in the economy. And this growth has been broad-based. If you see the sectoral data, so agriculture, industry and services, the main sectors grew by, in the first half, by 0.6% agriculture sector, industry 7.9%, and the services sector by 3.3%. And also we see from the leading indicators, especially Purchasing Managers Index, PMI, in all three sectors, manufacturing, services and construction, they're all above the threshold value of 50% in recent months. So we see the momentum continuing in the economy, and we expect around 4.5% growth year on year during 2025. So inflation based on CCPI turned positive in August 2025. That is after 11 months of deflation from September 2024. And in August, inflation recorded 1.2% year-on-year increase. And core inflation, so which is the mainly we use for monetary policy purposes, and that shows underlying demand conditions in the economy, and is also at low levels, around 2%. And if you see the factors that contributed to headline inflation, and as you can see the graph to your right, and mainly the deceleration or easing of energy deflation, energy and transport deflation supported this acceleration in inflation, and also food and non-alcoholic beverage inflation in food and non-alcoholic beverage inflation also contributed to this acceleration in inflation. So inflation is projected to gradually increase towards the target of 5% by mid-2026, and that's we see recovering aggregate demand. So recovery of aggregate demand supports this increase of inflation to our target 5%, and we expect core inflation also increase and stabilize around the target for headline inflation, that is 5%. And credit to the private sector recorded notable increase, and also it's a broad-based expansion. We have seen credit distributed to all major sectors, services, industry, and also personal loans during this year. And we have seen about 200 billion credit expansion in the months of June and July. And also we see this momentum in August, and also we expect this momentum to continue in this year. So if you see the numbers, overall year-to-date expansion in credit up to July, from January it's around 900 billion rupees. And this credit expansion is supported by the low interest rate environment. As you all know, we have been central bank has been having accommodative monetary policy since June 2023. And if you see this graph to your left, and it shows the bar chart, it shows the reduction in interest rates, main interest rates in 2024 and 2025. And overnight policy rate, that's our policy rate, was reduced by 150 basis points. And in line with that accommodative monetary policy, we see AWCMR, that's our operational target, reduced by by 138 basis points. And other interest rates like average weighted prime lending rate, there was a decrease around more than 4 percentage points. And AWLR, so that's the lending rate of the lending portfolio of banks, the rate reduced by around 2.7 percentage points. And the deposit rates also reduced around 4.8 percentage points during 2024 and 2025 thus far. And treasury bill rate, that's the mostly decreased rate. It was reduced by around 7 percentage points during this period. And you can see the reduction in these line charts as well. The external sector remained resilient, supported by improved inflows from tourism and workers' remittances, despite a widening trade deficit. So as you can see from this graph to your left, the tourist arrivals, it has been above the averages in 2024 and 2023 as well in this year. And we have received tourist income of around US dollars 2.3 billion from January to August 2025 compared to 2.2 billion in January to August 2024. And workers' remittances has been performing very well. And this year, January to August, we have received workers' remittances around 5.1 billion. That's around more than 19% growth compared to the review period in 2024. In 2024, we received around 4.3 billion US dollars. And the external trade performance, so we have seen some increase in trade deficit. And if you see July month, the exports was around 1.3 billion. We received export income of around 1.3 billion and imports around 1.9 billion. And the trade deficit was around 0.6 billion. But we see some reduction in August import values. And with this trade deficit, still we see trade overall current account surplus monthly basis. So if you can see this chart to your right, so we have seen current account surplus in each month from January to onwards, mainly due to improvements in workers' remittances and tourist income. And continued net foreign exchange purchases by the central bank have helped maintain gross official reserves above 6 billion amid debt service payments. So you can see in August, gross official reserves was at 6.2 billion. And thus far, until January to August 2025, we have purchased from the domestic forex market. Central bank has purchased around $1.2 billion that was added to the gross official reserves. And during this time, there was some depreciation of the currency in rupee. That's around 3.3% depreciation during this year. And also we have seen good news that now with the improvement or upgrade in S&P ratings, sovereign ratings, so we see that all three major rating agencies now raised Sri Lanka's sovereign ratings from default status. So the Monetary Policy Board will continue to monitor and assess incoming data on developments in the domestic and global fronts and emerging markets. And the board remains prepared to implement appropriate policy measures to ensure inflation stabilizes around the target of 5% while supporting the economy to reach its potential. Thank you.